CVS is trading at a 52-week low, and in this video, I want to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my discounted cash flow model to see what price you should pay for the stock in order to make a good return on your money. Starting with their financials and with revenue growth, you can see that this is a company that is not a fast-growing company. However, this is also not a dying company, and over the past 5 years, they have grown at an average of 10%, and last year they grew 11%. If we take a look at what analysts are expecting for the next 5 years, they are expecting this company to go from $353 billion to $393 billion, which is an average of 4% growth per year. Regarding their margins, this company has very thin margins. Their profit margin over the last 5 years was at an average of 2.2%, and their free cash flow margin was at an average of 4.7%. Thin margins are common in this industry. For example, a company like Walgreens also has very thin margins. As you can see in their margins, they have more free cash flow than net income. Last year, they made $13 billion of free cash flow and only $4 billion of net income. This is something that I actually like because net income can fluctuate more because it has a lot of accounting rules and it can be manipulated. On the other hand, free cash flow is simply cash from operations less your capital expenditures. Now I am going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I am going to do a 7-year analysis and do low, middle, and high assumptions. I am going to quickly explain my assumptions before revealing the prices. Regarding revenue growth, we have already taken a look at it. We saw that they have grown 10% for the past 5 years, but that analysts are expecting an average of 4% for the next 5. Therefore, on my low assumptions, I went with 3%, middle with 4%, and high with 5%. And I think I am being a little bit conservative. We have also taken a look at margins. For profit margin, even though on the Excel you're seeing 2% on all my assumptions, I actually put 1.75 on my low assumptions, 2 on my middle, and 2.25 on my high assumptions, but Excel just rounds it up. We have seen that they have a higher free cash flow, so I went with 4, 4.5, and 5%. Then, for P and price to free cash flow, what I do is that I start at 15 because it's the market average, and then, depending if the company has a moat or growth potential, I assign higher or lower multiples. I don't think CVS has huge growth potential or a moat, therefore I went around the market average and put 14, 15, and 16. Finally, for my desired annual return, because you can get around 9% investing in an ETF, if you take the risk of investing in an individual stock, your rate of return should be higher. And you should put a higher return as your assumptions get higher because it is less probable that they occur. Therefore, I went with 10, 12, and 14. And now let's see the prices. As you can see, there are 6 numbers. The top 3 numbers are based on profit margins and the 3 bottom ones are based on free cash flow. And based on net income, the stock is worth between $65 a share and $83. And based on free cash flow between $150 and $185. So it looks very undervalued according to my Excel spreadsheet, and as I said before, I prefer free cash flow than earnings. The stock is currently trading at $66 a share, and based on free cash flow, these numbers mean that if the low assumptions occur, you're going to make a 27% annualized return on your money, including dividends because they come from free cash flow. If the middle assumptions occur, you're going to make a 32% return, and if the high assumptions occur, a 37% annual return every year. So the returns are very, very good based on free cash flow. I also want to say that the Excel spreadsheet does not take into account the balance sheet of the company. So let's quickly take a look at it. CVS has $16 billion in cash and $82 billion in debt. This is a lot of debt, and if it was another company, I would be worried about it. However, in the case of CVS, this does not worry me because they have a lot of leases. It has very expensive leases because it wants prime real estate locations. In conclusion, I personally believe that CVS is trading at a very attractive valuation, and that if you have a long-term mentality, you can make a very good return on your money. I personally own this stock and my average is currently $66. I am going to dollar cost average as the stock drops, because I believe the market is very overvalued. Therefore, I am fully expecting the stock to drop and buy more shares. This is why I have started just a very small position. However, this does not mean you should buy the stock. This is not financial advice and you should always do your own research. I hope you enjoyed the analysis and I'll see you on the next one.